Hey there, IFA subscribers. It's your friendly neighborhood advisor, Luca, again, here with another anecdote to keep your seatbelt on when times are telling you to unclick and just take the ride. You know, a lot of wise investors alter their approaches as market cycles shift, from bull to bear to something in between. A consistent strategy, which is not to be confused with strategy in general, can be a far riskier one than one that involves tactical shifts according to the season. Take a person who loves wearing shorts and a t-shirt all the time. They love this so much that they wear the skimpy attire all year round, no matter how cold it is outside. They do this for two main reasons. It could just be the style now, or they're comfortable with this, and that's how they've always done it. They just don't know any better, or they don't know to look for alternatives. This reminds me a lot of how individual investors behave. They follow a traditional asset allocation, buy and hold approach, regardless of what the market's doing. This and any other strategy works just fine in a bull market, just like wearing shorts and a t-shirt is just fine during the summer and the end of summer. But it gets you crushed in a down market or one of those cold days. So speaking of which, let's talk about the three main types of markets. Each requires its own investment strategy. There's the so easy a caveman could do it market. In such bullish times, the market appears to go up in a straight line. Even someone with a brain the size of a walnut, hence the caveman reference, could make about 20% a year. Apologies to any cavemen or cavewomen. The markets in 2019 and 2021 were two great examples of this. In these types of markets, just about anything that you invested in worked well. This is true with an asset allocation or a trend-following tactical strategy. Then we have the opposite. We have a bear market. This is one that goes down quite a bit, sometimes in a short amount of time. Great examples of this were 2007 to 2009, when the S&P 500 lost more than 50% of its value over 16 months, or COVID-19 induced bear market that cut over 30% from the S&P in a very short period of time. Also the shortest bear market in history. Just about any strategy that has you fully invested in equities gets hurt in this type of market. This is just like that person wearing shorts in the dead of winter. They may feel comfortable because everyone's doing it, but they're freezing their butt off. In this market, a better strategy might be where an investor is partly in cash and maybe a mix of very short-term bonds and equities that aren't too sensitive to interest rates, going either way. Then we have the risky market. Here, volatility is abnormally high, which produces some returns, but has a great risk of falling into a slump. This current cycle that we're going through embodies this. I'm not telling you something you don't already know. While the market has gained some but lost more throughout this year, the risk is still immense. Volatility is low at the moment, but any bad news from anywhere, Ukraine, the Fed, inflation, supply chains, can change that in a second. This is mainly due to dour sentiment more than fundamentals and data. The average investor is just so inclined to look for data to support the doom and gloom mentality that they're willing to sacrifice returns in the favor of saying, I told you so, or this time it's different. Although a fully invested strategy in this market could work out okay, the risk might not be worth it. This is like the person wearing shorts in the fall. If they get a warm day, they're fine. If they don't, they get really cold. Having a good tactical strategy often trails a fully invested approach if the market is going up in the face of great risk, albeit with less volatility. But it protects you if the risky market turns bearish. With this strategy, known as tactical asset allocation, you alter the mix of your assets based on price performance. You favor asset classes trending upward and unload those going down. Sounds easier said than done, I know. Rather than trying to determine future Fed moves, inflation, stock valuations, I suggest focusing on sentiment, which I think has been the primary negative influence on stocks this year. Inflation dread is a primary contributor to that, as it feeds into Fed fears. So if inflation moderates over the period ahead, despite wiggles along the way, then it probably points to improving sentiment. See a high likelihood of that happening. So in short, between falling food and energy commodity prices, slowing money supply growth, falling gas prices, the big moderation in purchasing managers' index price gauges, falling shipping costs, and a nascent drop in housing costs, there's ample reasons to think that the inflation rate is set to slow down, gradually and irregularly, over the foreseeable future. As hard as it may seem, try to think longer term, both now and as data and markets wobble from here, because they will. Nothing moves in a straight line, be it inflation data or a stock market recovery. Even a new stock market low is possible if sentiment stays bad enough for long enough. But new bull markets usually begin when investors think any light at the end of the tunnel must be another train. And that mentality sure reigns today. That suggests that a recovery and a new bull market is close by, if it isn't already underway. Thanks again for listening. We hope to see you soon. I hope it was informative. Take care.